40% correction in stocks coming in April. Let's talk about your latest forecast.
Well, we've been in a slowdown in the economy since 2007 because the baby boomers peaked in spending. That's something I was predicting for 20 years. That's our 40-year and our demographic cycle, which is quite precise. And so what have we gotten? Quantitative easing to fill the gap. Well, quantitative easing has created the biggest financial asset bubble. You look at stocks today and think we were in the greatest economy getting ready to get way greater. And what we've really had is an unrecovery. We've been growing at 1.65% since the 2009 bottom, with massive stimulus, with very low inflation. We should have high inflation and high growth with this much stimulus. And it's because they're fighting a declining tide. And the cost of this, not allowing recession, not allowing the bubbles and the debt to shake down like we normally do, we've got a monster financial asset bubble. Daniela, the most important number in the world right now is $520 trillion. That is, by the way, 6.2 times 84 trillion GDP in financial assets, stocks, real estate, bonds, that sort of stuff. Normally that would be 2 times GDP, maybe 2.5 in a normal boom.
Yeah.
Debts at 253 trillion, that's off the charts, over 3 times global GDP. But normally that'd be 1.5, so they use this financial asset bubble to offset the debt deleveraging and the debt bubble bursting. And now we have a bigger monster. And I am predicting within weeks or months, the central bank's just going to lose control over it. It's just going to burst. If you notice, and this is the reason for my prediction here that we're going to see a 40% plus crash in just the next few months. Every correction since the January 2018 top, that was when the real bubble started to top. And then we get all this seesaw backing up. We get a crash, we get a new high, and then every time we've got a crash to new lows, which means the market is trying to go down. We've peaked, and the next new low would project 2,100 on the S&P 500. That would be 45% from the recent top. That would mean the tech stocks would go down even more, maybe 50%. So I think the next crash, what people finally see is the central banks keep pumping up the economy against these downtrends, creating this monster bubble that keeps wanting to burst and deleverage along with the debt, and it's a losing battle. And when people say, don't print another, I'm sorry, don't bother to print another 10 trillion this time. This thing's over. They lose control, and that's just going to be the first crash, and we'll end up by late 2022 or early 2023 back down 80 to 90% to basically erase this entire crazy bubble. Now remember, greatest bubble in history has occurred from 2009 into 2021 with the weakest recovery in history. Is the biggest disconnect between stocks and financial assets and the real economy. And guess which one wins? The financial assets and the stocks have to come down to reality. Hundreds of trillions, Daniela, at least 200 trillion minimum of this 520 is going to disappear in the next 2 to 3 years. And that does not cause a recession, that causes a depression.
Wow. Okay. I have a lot more questions now. So one, just getting back to the central bank. So you're saying the Fed can't even, with the correction coming, the Fed can't even save it here with their liquidity pumping?
Okay. What did they just do? We had the COVID crisis, perfect trigger, by the way, because it's hit a death blow to the economy. We've recovered V-shaped 80% back, but we can't get back to 100 because there's a lot of industries that simply can't. Travel, entertainment, large parts of retail, on and on and on. So they printed in 8 months as much as they did in the entire 80-month QE cycle before it. So they're having to print exponentially more to stop each crisis. And guess what? We're already, the consumer spending, and I've been predicting this, already weakening again. And basically, people say, well, wait a minute, you just printed so much. I mean, the market did race to new highs on that, but the market's way ahead of itself and the economy is not following it. So when people see, it doesn't matter how much they print anymore, they're going to have to print $10 trillion next time. And people are just going to say, I'm sorry, the investors are going to say, I'm sorry, I'm not betting on this double down, double down, double down, double down theory. Because you know what happens when you keep doubling down. I don't care how many times you win, you end up at zero.
I believe in the book you were looking at early 2020. So are you just a bit off on your timing then in terms of, the market imploding here?
No, there is no timing anymore. This thing could have peaked in late 2009, early 2020. COVID came in, and the government, the Federal Reserve, and now for the first time, fiscal stimulus. So here's the series here. 3.6 trillion printed, as much as all the QE before in a short period of time. Government comes up with about 3.6 trillion in stimulus, and this time they give a lot of it direct to consumers and businesses, which is at least the better thing to do than just pumping up financial assets and making the rich richer. And now Biden wants another 1.9 trillion. Add all that up. Oh, we got about 9 trillion. Oh, let's call that over 40% of our GDP. We're money printing or fiscal stimulus to offset a short-term downturn. Oh, how long can you do that? Oh, we're going to have a 4 trillion deficit probably in hindsight for this year, and series of 4 trillion deficits. We're going to be at 40 trillion debt by 2024. And I predicted this before the crisis because one way or the other, we've been doubling our federal debt every 2 administrations since Bush. Okay, 5 to 10 to 20, and now Trump comes in at 20, and it's going to be 40 by the time the next election comes and the next president comes in after this, because of all these deficits. So there's no way out of this. You can't keep fighting reality by just printing more money, something for nothing, and expect it. The way you actually deal with it is you restructure debt, get rid of zombie companies, clear the decks so the economy has room to grow again, and resources and people can be deflated. None of that happens when the government keeps covering everything over with free money. Banks don't have to write down loans. Oh, zombie companies don't have to fail. So what do? They limp along, employing people barely, surviving barely. That's our economy. That's why it's growing at 1.6%. And the baby boomers are in a downward spending trend, and the millennials will not turn up until 2023-24. And that's the good news. That's what's going to pull us out of this. If we let the bubble burst, deleverage debt, deleverage financial asset bubbles. That's what we did in 29 to 32. And guess what? We came screaming out of that downturn. It was nasty, but we deleveraged a lot of debt and financial bubbles.
Right.
And that allowed the economy to grow. You can't grow from here. Bull markets don't start from these heights and valuations and bubbles. It's impossible to start a new bull market. Our economists are saying, oh, we're going to have a new bull market with COVID. No way. I say no way. These economists don't understand economics. That's why I stopped taking economics in my 3rd course and studied business instead.